Okay, excellent. Excellent. So better off with Roth. So today we'll focus on how we can utilize a Roth feature in our tax planning, investment planning, retirement planning, and where we can use those different investment vehicles and where the Roth might fit. So without further ado, Mara, please take it from here, and we're happy to be part of it.
Thank you so much for that introduction. So nice to meet everyone. Again, my name's Mara Kosoff. I'm a financial planning and coaching specialist here at Vanguard, where my role is to help educate, coach, and consult on various financial planning topics, just like the one that we'll be talking about today, all about Roth accounts and Roth conversions. Now, what you see on the screen, you might be thinking, is that a typo on the screen with the better off with Roth? Not a typo. BETR stands for break-even tax rate. That break-even tax rate, that is Vanguard's differentiated approach to assessing whether a Roth conversion will ultimately be worth it for you with your specific situation and your financial planning and tax planning goals. Because I'd say Roth IRAs and Roth conversions in general, it's always been a popular topic of conversation. As mentioned, I was a financial advisor for years before I was a specialist here at Vanguard. But I really say I've been talking to advisors about this over the past few months. There must have been some sort of YouTube video that went super viral about Roth conversions because now more than ever, I've been getting so many questions. So we need to make sure you understand what Roths are, what the appeal is, but equally as important, what are the considerations? Because Roth conversions, they do not make sense for every single person every single year. Not at all. So how do you know, and right, you're already one step ahead working with a lovely advisory team to help you, but how do you know if this is going to potentially be a good move for you on a financial planning and tax planning front? Let's start with those Roth basics. Then we'll get into some of the pros and cons for Roths in general. The way that I will simplify it for us here, there are rules, of course, with how much you can contribute to an IRA in general. And then there's also rules that dictate, are you even allowed to contribute directly to a Roth IRA? Because you might be wondering, I know Roth IRAs exist. Why do Roth conversions exist? Well, the reason is it can be pretty easy, depending on your income level, to phase out of the range of being allowed to contribute directly to a Roth IRA. Admittedly, this slide deck, the numbers were updated back in 2025. It's going through an update right now for 2026 numbers. So the numbers you see here are from tax year 2025. So in this year, if your income is above, if you're married filing jointly and your income is above $252,000, you make too much money to be able to contribute directly to a Roth IRA. So maybe you contribute to a traditional IRA and then you convert, as an example, helping to answer that question of why do Roth conversions exist and why do people talk about them so often? There's also another side to IRAs in general to know of when we're talking about conversions and kind of giving you the lay of the land, so to speak. With even traditional IRA contributions, there's no income phase out range. You can make a ton of money and still contribute to a traditional IRA. The question comes in of, can you deduct that contribution into that traditional IRA? Those numbers for 2026, let me find them here. Forgive me while I find the specific area I'm looking for. So again, if you are married filing jointly and your income is $149,000 or more, you cannot deduct your traditional IRA contributions if you're also covered by a retirement plan at work. Why does that matter? Well, with Roth conversions, let's say you make too much money to deduct that contribution in your traditional IRA, and of course, you make too much money to contribute directly to a Roth. You could make what's called a non-deductible contribution to that traditional IRA. It's after-tax money going into that traditional IRA, and then you immediately convert to Roth. So that after-tax money then is moved over to that Roth IRA. At its core, the question of, do I want to be contributing to a traditional IRA, that pre-tax IRA, if you're able to make those deductible contributions, or do I contribute to a Roth IRA, or do I pursue a Roth conversion? It ultimately comes down to the question, what is your tax picture look like? What's going to benefit you more? With those pre-tax, that traditional IRA, you're not paying taxes in the current year if you're able to make that deductible contribution. You get that tax deferred growth for years and years and years. But then eventually you reach, for instance, age 73, when Uncle Sam comes knocking on your door saying, okay, you've enjoyed that tax deferred growth for far too long. Time to cough up some of those taxes and start taking out some of that money from that traditional IRA. So if you are investing in a traditional IRA, you are going to eventually hit that point where those required minimum distributions begin for you. Paying those taxes at that future rate, which again, we don't know what those future tax rates are going to look like. We know what our tax rates look like right now, and we can use those numbers for tax planning, but ultimately what those future rates look like is anyone's guess. Then the other side is Roth. You pay taxes in the year that you make that contribution because you're not able to deduct a contribution into a Roth IRA. You enjoy that tax-free growth really forever, because then when you make those distributions in retirement, those Roth distributions are tax-free. So you are paying taxes today at known tax rates and then enjoying tax-free growth and tax-free withdrawals in retirement. So it's the question of, do I want to pay taxes now or later, in its simplest form? With Roth IRAs, it gets very complicated, the withdrawal rules. So I'm just going to lay out a few of them here to kind of keep things simple and high level. There's a distribution order. When you're taking money out of a Roth IRA, what the IRS says is your first distribution, that is coming from your contributions, which, by the way, you are always allowed to take out your contributions from a Roth IRA tax and penalty free there, because what the IRS basically says is, we're giving you this amazing tax-free growth vehicle. If you don't want to take advantage of it, you put money in and you immediately take money out. That's not our problem. You're not able to take advantage of Roth. Fine, take your money out. So you technically are able to take your contributions out of Roth IRAs no matter the time, but ultimately not going to be tax beneficial for you. The next distribution order, if you want to think of this like order of operations, first one was contributions, second one is conversions. When you make those Roth conversions, that's going to be the next bucket when you ultimately take distributions. And then earnings in that Roth IRA, those are that last bucket. There is a 5-year rule for Roth IRAs. So if you've heard of that 5-year rule where you cannot take out your earnings tax and penalty free unless it's been in there for 5 years and you are 59 and a half, you're absolutely right. There are rules about being able to ultimately take your earnings out tax and penalty free, and that's where that 5-year rule comes to play. However, there's an additional 5-year rule that's talked about less so, which is for Roth conversions. Your Roth conversions also have to be in that Roth IRA for at least 5 years, unless you are over 59 and a half. But for all my friends out there who are younger than 59 and a half and making those Roth conversions, each Roth conversion has its own 5-year clock. So you can see these Roth conversions and just Roth distributions in general, it is so important to be intentional about your distributions, especially if you're younger than 59 and a half, to make sure if I'm exceeding those contributions, am I dipping into my conversions? Am I allowed to dip into my conversions tax and penalty free? And then what happens to my earnings if I ultimately dip into those? All of that to say, that's why your Roth distributions tend to be the last ones that you touch as a part of your financial portfolio. You want to let that Roth continue to grow tax-free for as long as possible. I've mentioned a Roth conversion a few times here. So in its simplest form, what is a Roth conversion? How does it work? You have that tax-deferred retirement account, a traditional IRA for this example. You pay taxes. Let's say we have a traditional IRA that has $10,000 in it, and we want to convert $5,000 of that. When we convert $5,000, we're paying taxes on that $5,000. That $5,000 is going to be included in our taxable income. And then once that $5,000 is in that Roth IRA, any future earnings grow tax-free because it's housed within that Roth IRA now. So it's the question of, do I pay taxes now to then enjoy tax-free growth for the rest of the time that that IRA, that Roth IRA is funded? There's a few conversion strategies that you've probably heard of most commonly. We talk about Roth, backdoor Roth contributions, as well as mega backdoor Roth conversions. Both of these strategies exist for folks where you make too much money to contribute directly into a Roth IRA. So with these backdoor Roth contributions, I kind of alluded to this strategy in the first place. Let's say that you make a $7,000 traditional IRA contribution, and that contribution, you make too much money to be able to contribute directly to a Roth. So you also make too much money to be able to deduct that traditional IRA contribution. So it's a non-deductible contribution into that traditional IRA. My example was $7,000. So you don't get any tax benefit in the current year for making that traditional IRA contribution because it's not deductible. You make too much money. Then you immediately convert that contribution from that traditional IRA to the Roth IRA so that then that $7,000 in my example can continue to grow tax-free for as long until you eventually withdraw that Roth, and then the withdrawals are tax-free, but ultimately you want that money to grow tax-free for as long as humanly possible. So that's why it's called a backdoor Roth contribution, because the contribution does eventually go into your Roth IRA, but we got to do it through that back door where it first hits that traditional IRA where you're allowed to make that contribution. It's really important here, though, and this is why working with an advisor is so important if you are pursuing a backdoor Roth contribution strategy. There's a little something called the pro rata rule. What the pro rata rule says, if you make a contribution, you make an after-tax contribution into a traditional IRA that already has pre-tax money in it, now you have a mix of pre-tax money and after-tax, that non-deductible contribution money, all in the same traditional IRA. Or even if you have two different traditional IRAs and one is all pre-tax money for maybe you had an old 401k that you rolled into that traditional IRA, then you opened a separate traditional IRA and you made a non-deductible contribution in it. At the end of the day, the IRS looks at all of your traditional IRAs, they aggregate them. You could have 50 different traditional IRAs. IRS all looks at it as one big pile. If you have a mix of pre-tax and after-tax money in it, things are going to get a bit complicated if you try to do a Roth conversion. So let's take a quick example to show why. Let's say out of all your traditional IRAs, you've made $50,000 worth of pre-tax IRA contributions. Those eventually grow to $63,000. So there's $63,000 in pre-tax across your traditional IRAs. Then you make a non-deductible contribution, that after-tax IRA contribution of $7,000, like in my example that I gave. So that's $7,000 of a non-deductible IRA contribution, creating what is called basis in the IRA, if you've heard of that. So then if you move forward and you say, I want to convert some money to a Roth IRA, what the IRS is going to say is they're going to say that pro rata rule exists. To be able to calculate the amount of money that you are going to owe in taxes on every conversion, they divide the amount of pre-tax money that you have in your traditional IRAs by the total balance of those traditional IRAs. So then every single Roth conversion you make, 90% in our specific example, 90% of every single conversion is taxable. So if you pursued this strategy because you thought, I'm making a $7,000 non-deductible contribution and I just want to convert that one, so I won't run into the pro rata rule because it's already after tax and I'm not going to owe any additional taxes. IRS says, hold on, that's not the way that it works. You have part of your traditional IRAs in pre-tax, and now part of it is in this after-tax non-deductible contribution. So every conversion is 90% taxable. So that $7,000 conversion that you thought you weren't going to owe additional taxes on, $6,300 of that is actually going to be taxable. Only $700 of it is going to be able to avoid additional taxes. The bottom line here, pro rata, it gets very messy, and it's up to you to keep track of the pro rata conversion amounts that you have to be applying when you are paying taxes. So that's why Roth conversions honestly gain a lot of attention in the first place, because it's the question of, if I want to make that backdoor Roth contribution, is it worth it for me before I make that contribution? Should I convert all of my pre-tax IRA to Roth to then unlock the ability to make that backdoor Roth contribution? At the end of the day, the answer might be yes, the answer might be no. It's ultimately going to come down to your specific tax situation of if it is worth it for you to be doing a complete conversion to unlock that backdoor Roth contribution strategy. But that's another opportunity, another reason why always good to be working with a financial advisor who can help walk you through if it's actually worth it for you or not. Now, this next one, mega backdoor Roth conversion. This gets additionally complicated. This lives within your employer retirement plan, your workplace plan. Backdoor Roth conversions, even to be eligible for a backdoor Roth conversion, your workplace plan must permit after-tax contributions and include one or both of the following: a Roth 401k option with the additional option of an in-plan Roth conversion, or an in-service non-hardship withdrawal of after-tax contributions to an outside Roth IRA. The whole idea here is that for our high income earners, this can be an opportunity for you to contribute a pretty large sum of money on an annual basis to the Roth side of your portfolio. The way that this works is there's an order of operations to it, as there really is with anything involving Roth. That first step is to max out either the traditional or Roth side of your 401k. So in 2026, to max out the, let's say I'm doing a pre-tax contribution to a 401k, I'm over age 50, I can contribute $32,500. The second step here, let's say I receive an employer match or an employer contribution into my 401k of $7,500, bringing those contributions to an even 40 grand. However, if my workplace plan allows me to then make after-tax contributions, think of that, that's like a whole other side of your 401k, completely separate from the pre-tax side, completely separate from the Roth side. Think of it like another pocket, that after-tax contribution pocket. You can make, with my example here, there's already $40,000 in that 401k. You can make up to a $32,000, or I guess with age 70, age 50 or older, it's going to be even higher than that. There's an annual maximum amount of what an individual can make into a 401k, in addition to the employee deferral and in addition to the employer match. That's in like the $72,000 range. Then that's where the after-tax contributions come in. You make an additional 30 grand of an after-tax contribution, and then you immediately convert that to either the Roth side of your 401k, or if your plan allows the in-service non-hardship withdrawals, you can roll that into an outside Roth IRA. The point being, if you are a high-income earner, if your workplace plan allows it, there could be tens of thousands of dollars more that you can save into the after-tax side and then convert to Roth. I'll give an example of, for a lot of folks, workplace plans don't allow this. Vanguard's one of them. None of us are allowed to make those after-tax contributions, so we can't take advantage of mega backdoor Roth conversions. So it's not going to apply to everyone, but for who it does apply to, it can be really helpful just kind of stashing away additional money into that Roth side of your portfolio. Now let's answer the question, how are Roth conversions used for financial planning? And how do you know if it might be a good year for you to pursue a Roth conversion? When are they used? Well, they're used for those tax-free growth and tax-free withdrawals in retirement. Helps you save more on an after-tax basis. The key here, those Roth IRAs, there's no RMDs. Like I mentioned before, Uncle Sam is not going to come knocking on your door in your 70s forcing you to take money out like he's going to in your traditional IRA. This leads to a whole other, I like to call it a domino effect, because if we have smaller RMDs or no RMDs when we are retired, that's going to lead to our income being lower versus if we did have RMDs. Having lower income can lead to a lower portion, a smaller portion of our Social Security benefits being taxed once we're in our 60s, 70s, 80s, what have you. That can also lead to a lower IRMA surcharge for you. Remember, IRMA is that income-related monthly adjustment amount, that Medicare surcharge assessed on your Part B and Part D monthly premiums. So if our income is lower because we have a larger chunk of our portfolio in a Roth IRA, maybe we aren't going to owe any IRMA, or maybe our IRMA is just going to be at a lower level versus if we had these massive RMDs by the time we reach our 70s. As mentioned, it allows you to lock in today's tax rates. We have no clue what tax rates are going to look like in 5, 10, 15 years, what have you. Anything you see where we're talking about tax rates made permanent today literally can be changed. Whatever administrative regime comes in next, they could completely overhaul our entire ordinary bracket system, if you want to think about it like that. Whether that would benefit them or not in re-election, who knows? But the point being, we know what our tax rates look like today. We don't know what they look like in 10, 15 years from now. And then a huge reason why some folks pursue Roth conversions, estate planning. I talked to a lot of clients where they say, I want my children to inherit my assets tax-free. I do not want them to have to pay taxes on the money that I am passing down to them, the assets that I am passing down to them, especially with those new Secure Act rules for inherited IRA distributions and those RMD rules. Now for non-eligible designated beneficiaries, which remember, if you are leaving your assets to, let's say, your adult children, I'd say those are the most common non-eligible designated beneficiaries, they're now going to be subject to that 10-year rule, where they have to completely empty out that inherited IRA, whether it's a traditional IRA or Roth IRA, by the end of that 10th year. If they are inheriting a traditional IRA, when they make distributions, they're going to have to be paying taxes on those distributions. However, if they inherit that Roth IRA, they can let that Roth continue to grow tax-free for another 10 years. And then right by the end of that 10th year, they'll be forced to distribute the whole thing. But that's where the Secure Act changes to RMD rules. I had so many more clients wanting to convert money to Roth so that their kids would have a tax-free inheritance. My warning there, though, you want to take a look at your entire family's tax planning picture. What if your children are in a much lower tax bracket than you are? Is it really worth it for you to be paying taxes at the 37% marginal rate when maybe your children will inherit that IRA and pay taxes on those distributions at the 22% rate, as an example? So thinking about that term as well of, is it going to be, what's going to save my family the most money? What's going to give my family the most bang for our buck? The answer is not always to convert so that your children receive that tax-free inheritance, unless your ultimate goal is the tax-free inheritance and you're like, I'm willing to pay more in taxes. My main goal is my kid not having to pay those taxes. How do you know if you're a good candidate for a Roth conversion in the given year? Let's say you had a low income year. I had some clients where unfortunately they got let go from their job, and that was a great opportunity for us to be converting some money to Roth because their income was going to be lower. So it gave us more wiggle room to be able to convert money to Roth and either not bump them into a higher tax bracket, or even if we bumped them into a higher tax bracket, it still wasn't as high as it was when they were having their usual level of earned income. So a low income year, that also means if you're a business owner with income flexibility, and there are some years where you can make it where your income is lower in some years more than others, maybe in those lower income showing years, you pursue Roth conversions. Or you're a retiree in a low tax bracket. I had a lot of clients where they're retiring, let's say they retire at age 60. And the goal was for us to slowly but surely convert some money to Roth on an annual basis so that by the time they were reaching age 73 for their RMDs, those RMDs were going to be a lot smaller. We had the opportunity to do that because they were retired and their income was lower anyway. There's a few other reasons here. You want to set up a surviving spouse for tax flexibility. Again, that kind of plays into that whole estate planning opportunity of, do we want our heirs to be receiving that tax-free inheritance? Equally as important as Roth conversions being a good idea, they could also be a very bad idea, depending on your tax year. I once had an advisor, he opened up this sort of meeting with his clients and he said, Roth IRAs or Roth conversions, they can be the absolute best thing for your portfolio And they can also be the absolute most devastating thing for your portfolio at the same time. And the way that we described that was it all depends on your unique tax situation. Your best friend who you spoke with, where it was a great year for their Roth conversions, that could have looked completely different than what it is for you. So if you are someone where, let's say, you need every dollar for living expenses, you don't have a lot of money set aside that can just be used to pay for Roth conversions. Because remember, Roth conversions, they come at a cost. The cost is those taxes. You have to make sure that you have that money set aside to be able to afford those taxes that you are paying. So if it's a year where maybe we don't have as much free cash flow, might not be a good idea for those Roth conversions in that given year. Or maybe your taxable income is extremely high this year. I remember I had a client where we had been doing some Roth conversions for them. And then there was a given year where they both made great money and their bonuses were higher than normal. It was not going to be a good year for them to do a Roth conversion because that would have bumped them up into a much higher tax bracket. So you need to be really intentional with when you are actually pursuing these conversions. You could talk to your advisor one year and it's, yes, this is a great year for a Roth conversion, convert $10,000, $20,000, what have you. And then the next year you go in their office and you're like, oh, how much are we converting this year? And they say $0. We do not want you to convert. It is actually going to be doing you a disservice if you convert this year because of your income situation. And then a really key component here, if you have a short-term time horizon, Roth conversions might not make any sense for you. The whole benefit of a Roth conversion is how many years of tax-free growth is your money going to have in that Roth IRA. If there's only 2 years of tax-free growth before you're going to start distributing those assets, I'm not sure if it's going to be worth it for you to pay the conversion taxes in that given year just for 2 years of growth, for an example. But again, it is all going to depend on your unique situation, your unique tax situation, your financial plan, your goals. Cannot emphasize enough how much with Roth conversions, there is no blanket recommendation that anyone can be giving. It is really so incredibly unique to you. It's also important to know what is the ripple effect of Roth conversions. What are those tax impacts? Because when you make a Roth conversion, again, that's additional income you are witnessing in that given year. If I make a $50,000 Roth conversion, that's an additional $50,000 that I am including in my taxable income. That can easily send me into a higher marginal tax bracket. That can potentially have me reach AMT territory, depending on what my income looks like, what my modified adjusted gross income looks like. Maybe because of this Roth conversion, maybe I was able to take advantage of being in the 0% capital gains bracket previously, able to maybe sell some individual stock, not having to pay any money on those capital gains. But I do this $50,000 Roth conversion, maybe all of a sudden I'm pushing myself into the 15 or 20% capital gains tax rate. That might not be intentional, but that is absolutely a consequence of a Roth conversion. Exposing yourself to net investment income tax. And then I mentioned a few here, triggering IRMA. So I kind of brought up IRMA on the good side, where if you have a Roth and you're taking money out of that Roth, it's not increasing your income. So maybe that income or that IRMA bracket is going to be a lower number. But the opposite of that, if I'm doing a Roth conversion, let's say I'm 65 and I'm exploring if a Roth conversion is going to be worth it for me, my Roth conversion might make my IRMA, might make my Part B monthly premium, instead of $200 per month, maybe now I'm paying $650 per month in Part B because of this Roth conversion. So we need to, when we're talking about the cost of Roth conversion, it's not really even just the taxes that you're paying on that money. It's being aware of all of these other parts of your tax situation, being really intentional there. And then the last one on this page, Social Security taxation. What your adjusted gross income looks like impacts a calculation that's called your provisional income. And that's what dictates what portion of your Social Security benefits will be included in your taxable income. Up to 85% of your Social Security benefits could be included in your taxable income. So paying attention, how much am I converting? How is that impacting my AGI? And how is that impacting that provisional income calculation so that you're able to know how is this going to impact my ultimate Social Security taxation? A few other areas of your tax picture to know of when you're making these Roth conversions. We'd say these are less visible costs and phase outs. Maybe with this Roth conversion, you now are no longer able to take advantage of that QBI deduction, that qualified business income deduction. Or one that's been really top of mind for folks, maybe with this Roth conversion, you've knocked yourself out of eligibility for those ACA subsidies. This one is extremely important, especially for my early retirees out there, where you are retiring before you are Medicare eligible age. Maybe you're picking up an ACA marketplace plan to help bridge the gap between that early retirement and being Medicare age. Well, you do that Roth conversion. If that pushes you above that 400% of the federal poverty level, now you are not allowed to have any sort of subsidy, any sort of monthly help on those health insurance premiums. And as we know, health insurance can cost us a pretty penny. So we want to make sure, is this Roth conversion, if it is going to knock us out of subsidy eligible range, is that ultimately worth it for the higher cost of your monthly health insurance premiums? So as you see here, the point is there are so many benefits to Roths. Vanguard, the whole reason we created a whole other side of assessing whether Roth conversions are worth it or not is because we think Roth conversions and Roth are worth their weight in gold. But that doesn't mean that enormous Roth conversions are worth it for every client on an annual basis. It is so important to only be pursuing those Roth conversions once we have discussed them in detail with our financial advisor so that we know when is it going to be a good idea for me to convert money to Roth? When is it not going to be a good idea? And how is this ultimately going to impact my specific financial plan, my specific goals, my specific legacy goals, and your cash flow needs? All of those different variables play into the ultimate question of should you be pursuing that Roth conversion or not? Now, before I open it up to any questions, what are some strategies to minimize your tax impact on pursuing Roth conversions? Multi-year conversions. As I mentioned, a lot of times it is not a good idea to do what I like to call a monster Roth conversion. Instead of converting $100,000 in this year, what if you converted $10,000 over the next 10 years? $20,000, right? What have you? Spreading that out over multiple years so that you are filling up a specific tax bracket every single one of those years, kind of staying low and steady versus jumping up into a really high bracket in just 1 year and paying that higher tax on the conversion itself. Being cognizant, converting prior to when you are RMD age, because you technically can still convert once you are RMD age, but you have to take the required minimum distribution out of your traditional IRA first before you are allowed to convert any money to Roth. So that's basically just potentially if you're converting the same amount that you have to take in an RMD, you could be doubling the amount that you are distributing from that traditional IRA, doubling the amount that you are then having to owe in taxes. And then another great idea, converting when the market is down. Great opportunity. Let's say that you are wanting to convert, again, $100,000 in my example. And when the market is doing really good, maybe that's only, I'm going to keep my numbers easy, maybe that's only 10 shares, right, of a specific company. And then the market's down. And so for $100,000, you're able to actually convert 15 shares of that company while still only converting $100,000. And so by the time that money enters that Roth IRA, when the market rebounds and goes back up, now you have that extra 5 shares in the Roth IRA that are also going up in value, but in a tax-free fashion, versus when the market was doing well and you were getting more bang for your buck with that $100,000 conversion. So think of it like you're able to convert more shares for the same cost when the market's down. Just a good opportunity of looking whenever there's market volatility. While it's not great when we're looking at our numbers of our accounts, it is great for tax planning opportunities. Can we convert to Roth? Are there any tax loss harvesting opportunities? Things along those lines. So using that to your advantage when you are pursuing a Roth conversion strategy. Now I'll open it up here. As promised, only wanted to go over this. Can get really, really complicated with Roths.